Hello everyone. Today we shall take a quick dive into markets and our outlook on the same. Let's examine what's happening across the globe. Where does India stand? And how can you position your investments in this evolving environment? Let's start with the global stage. The US economy is holding up, but sentiment is shaky. Consumers are still spending, but confidence has dipped, mainly due to tariff tensions and policy uncertainty. Inflation is stuck in a tight range, but the impact of tariffs is yet unclear. In China, stimulus efforts have had limited success, and growth is still sluggish. Europe's growth is, however, more resilient than expected. Emerging markets, meanwhile, are in a wait-and-watch mode, responding cautiously to global trade dynamics. Let's examine the India situation. In India, growth has moderated a bit. Consumer demand has softened and bank credit has slowed. Our discussions on US tariffs have not gone on expected lines, though negotiations cannot be said to be over. In the worst case, India's GDP could see an impact of about 1% and growth could compress 10 to 20 basis points, including direct and indirect effects. But here's the upside. Inflation in India is well under 4%. Monsoon and sowing activity are strong. RBI has already cut interest rates by 100 basis points and fiscal discipline remains intact. The government continues to push capex and the investment cycle remains well supported, especially in areas like power, defense, manufacturing, and real estate. We are also seeing signs of rural resilience thanks to better crop yields, rural schemes, and softer inflation. So, what are the markets telling us? Frontline indices like the Nifty may stay range bound until earnings growth improves, likely by the end of 2025. But that does not mean you sit on the sidelines. Opportunities abound in the broader markets, making strategies such as mid and small caps, flexi caps, and focused high conviction strategies relatively attractive. India's long-term growth story remains intact, and that's key to staying invested with conviction. The fixed income market is getting interesting as well, and if you are a debt investor, this could be your time. With inflation under control and fiscal discipline intact, long-term growth government bonds are turning attractive. In addition, high-quality corporate bonds, particularly in the 1 to 5 year segment, are offering spreads which are well above their historical averages. So how are we positioned? Our portfolio stance remains pro-cyclical. We are overweight on financials, industrials, and consumer discretionary because these are sectors which benefit from lower interest rates, taxation, and policy support. We are seeing the return of corporate capex, housing demand is strong, and mass consumption is steadily reviving. With demographics on our side, India's economic flywheel is expected to gather pace. So what should investors do? Stay diversified, stick to high quality portfolios, and not get spooked by short-term volatility. The next leg of growth could be driven by real income gains, rate tailwinds, and spending momentum. Remember, India's structural story is still strong, but it's important to stay the course. That's going to be your edge. If you found this useful, give it a thumbs up, subscribe for more actionable updates, and tell us in the comments how are you positioning your portfolio this year. Thanks for watching and see you in the next one.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.